Hi everybody. In the previous study guide lecture, we finished the pension plan worksheet for Carney Company, the PBO column and the plan assets column. In this video, we'll see how far we can get in finishing the rest of the columns. We're looking to fill in the little yellow boxes in each column. So let's turn our attention to the prior service cost AOCI column. The beginning balance given in the problem was $20 million, and there was a $40 million increase in this balance at the end of 2020 due to the new retroactive pension formula amendment. The only piece we're missing is the current year amortization of the beginning balance of the prior service cost, and the problem states that the old balance is being amortized at a rate of $5 million per year. So to finish this column, all we have to do is credit the prior service cost with $5 million, and that amortization will also increase the pension expense. So please write your debits and credits of the $5 million in the two columns, and then start the video again to check your work. So a $5 million credit to the prior service cost AOCI and a $5 million debit to pension expense. Now we can find a total of the prior service costs AOCI at the end of the year. Just add up the column. 20 million minus 5 million of amortization plus new service cost, prior service cost of 40 million equals an ending balance in the account of $55 million. Looking at the net loss AOCI, the only piece missing is the amortization of the net loss AOCI, if any. Remember that we do not even bother to amortize a net loss or a net gain unless it's a large amount, and the FASB defines a large amount as any amount in excess of the corridor. So there are 3 steps to calculate an amortization of the net loss, if any. First is calculate the corridor. The corridor is 10% of the larger of the PBO at the beginning of the year or the plan assets at the beginning of the year. The PBO was $830 million, the plan assets were $680 million. The PBO balance is larger, so the corridor is defined as 10% of $830 million in this example, or $83 million. That's the corridor. Step 2, calculate the amount of the beginning net loss, AOCI, in excess of the corridor. Well, $93 million beginning balance minus $83 million corridor equals $10 million in excess of the corridor. Step 3, divide the excess by the average remaining service life of active employees. The problem states that the average remaining service life of the active employee group is 10 years. So, $10 million amount in excess of the corridor divided by 10 years equals amortization of $1 million for 20X1. That amortization will increase the pension expense. So go ahead and write your debits and credits in these 2 columns, and then start the video again to check your work. So we recorded a $1 million credit in the net loss AOCI column and a $1 million debit in the pension expense column. Now all the numbers have been completed for the net loss AOCI column and the pension expense column. So go ahead and find your balance at December 31st X1 for both of those columns. Then start the video again to check your work. 93 plus 7 minus 1 plus 13 equals $112 million balance in the net loss AOCI column at December 31st X1. And pension expense for the year ended December 31st X1 is $95 million. That's the $74 million of service cost plus the $83 million of interest costs minus $68 million of expected return on assets plus $5 million of prior service cost amortization and $1 million amortization of the net loss. We're not going to bother to add up the cash column because there are tons of company cash transactions that do not affect the pension plan. So we will fill in the yellow boxes for the net pension liability or asset. On the company's balance sheet, we do not state the liability for the PBO and the plan asset debit balance separately. Instead, the two are merged or netted together, and if the liability, which is in this case larger than the plan assets, then it creates a net pension liability. If the plan assets are larger than the liability, then it would be a net pension asset. Only the numbers that affect the PBO or the plan asset columns go into the calculation of the net pension liability or asset column. If the numbers are in other columns, don't put them, they don't belong in the net column. So go ahead and fill in all the yellow boxes with a credit or a debit, depending on what's here, and then calculate your net pension liability or asset at the end of the year. Start the video again to check your work. Service costs increased the PBO with a $74 million credit. $74 million credit in this column. Interest costs increased the PBO with an $83 million credit. $83 million credit in this column. Plan assets were increased by the expected return on assets and decreased by the loss because the actual return was less than expected. So a $68 million debit to this column and a $7 million credit to this column. None of these numbers affected either the PBO or the plan asset column. The $13 million credit to the PB for loss on PBO is already in this column. We credited the PBO for the prior service cost new, so a credit in this column. The $84 million debit to the plan assets is already in the column, and the $50 million debit to the PBO and credit to plan assets offset each other, 50 minus 50, to have 0 in this column. Adding them all up, you have a $215 million underfunded pension and a net pension liability. You can check to see if this number is right by taking the $990 million liability for the PBO minus the plan asset debit of $775, net those two together, and it is $215 million underfunded liability. Well, that's all for this video. In the next video, we'll write the journal entries necessary to record the various aspects of the pension plan for 20X1. See you next time.